What I thought we would do is spend a few minutes talking about some of the questions from Chapter 5, and if this is successful, that's something that I want to do in future chapters. Some of these questions can be a little bit confusing, and I want to provide a little bit of clarification in regards to these questions. So the first question that we want to talk about, the question is, which of the following would not affect an auditor's judgment concerning internal controls? The assertion being tested, the design of the control, the operation of the control, or the level of inherent risk. Well, what this question is doing is it's taking your attention to the audit risk model. The audit risk model includes the inherent risk, the control risk, and the detection risk. The inherent risk and the control risk define the risk of material misstatement. Based upon the risk of material misstatement, the auditor will determine the nature, timing, and extent of our substantive audit procedures. So you notice here what we're talking about is internal controls. Well, internal controls are related to the control risk. Well, the control risk is a separate concept as compared to the inherent risk. But these two items together define the risk of material misstatement. And again, this is what we use in terms of determining how we're going to proceed with our substantive testing. And again, with our substantive testing, this is where we are measuring monetary misstatement. So when you look at this question here, what we're looking at is we're looking at the level of inherent risk is not going to affect the auditor's judgment concerning internal controls, because while these two work together, these are two separate concepts in regards to the measurement of the risk of material misstatement. The second question is actually very similar. What does the effectiveness of internal controls influence? Well, we basically have answered this question. It's going to influence the control risk as well as the risk of material misstatement. And again, keep in mind when we're talking about the risk of material misstatement, we are not saying that something bad has happened, only that there is the risk that something bad could happen. But let's also talk about the internal controls in regards to the control risk. Well, one of the things that we need to understand is that when we're talking about control risk, we're talking about basically the quality of the internal controls. So the idea is that as the controls are more effective, as management has concentrated their efforts in terms of developing these internal controls, the control risk is actually decreased. So there's an inverse relationship between the internal control effectiveness and control risk. The next question is a bit confusing, and hopefully I'll be able to provide a little guidance on this. The question is, or the statement is, an auditor gathers evidence on internal controls for which respective time period for the purpose of expressing an opinion on the control effectiveness and for testing controls in the financial period. So again, what we're looking at is an auditor gathers evidence for which respective time periods for the purpose of expressing an opinion on control effectiveness and for testing controls. Well, when we are expressing an opinion on control effectiveness based upon the Sarbanes-Oxley 404 testing, is our opinion of internal controls is based upon a specific date as of the end of the year. So we are expressing an opinion on control effectiveness as of the end of the year, but we are testing the controls in the financial statement throughout the year. So we're testing the controls throughout the year, but we are expressing the opinion as of the end of the year, which brings up an interesting point. Theoretically, we may, during the course of the year, identify control weaknesses. Well, as long as these control weaknesses are corrected and we're actually able to test the effectiveness of these new controls as of the end of the year, that's fine, because our opinion is based upon not what has happened throughout the year, but as of the end of the period. And again, this issue relates just to our opinion of the internal controls over financial reporting. The next question: which of the following would not be a factor in whether a control weakness would be considered to be a material weakness as opposed to a significant deficiency? So a significant deficiency and a material weakness, this is a differentiation that will determine whether or not we actually have to report this in the opinion letter. Well, the determination would certainly depend upon the materiality of the related balance. It certainly would be determined or be based upon the volume of transactions and the subjectivity of the account balances. So the answer is the last item, where we're looking at the nature of the client's industry. So the nature of the client's industry would certainly come into effect as we are determining which controls we need to test. But the reality is that once we determine which controls we need to test, our determination in terms of the effectiveness of these internal controls is based upon these other elements. The last point that we want to work through is this question here. Which of the following assertions would the auditor usually consider most relevant for accounts payable? Well, obviously accounts payable is a liability, and when we're thinking about assertions and the effort that the auditor puts into these assertions, we need to think about worst case scenario where someone or management is actually attempting to manipulate the financial statements. Well, if the management is interested in manipulating the financial statements, they would be interested in under-reporting liabilities. So the answer here is completeness, because completeness is where we go out and we search for liabilities and we determine whether or not these liabilities are actually a part of the financial statement. Now, since we're on the subject, let's talk about what we would be interested or primarily interested in if we were looking at assets. Well, again, if a person or an organization or management is interested in overstating their assets as part of the manipulation, what we would be interested in is existence. We would take a look at the financial statements and determine whether or not the assets that they're reporting are actually in existence. Okay, so it gives an example of the inverse relationship between existence and completeness. And again, as we are focusing on what's important, we're certainly going to be looking at existence and completeness in all the asset and liability accounts, but we certainly want to consider what's most relevant, and what's most relevant is what actually may take place if in fact management is interested in manipulating the statements. Okay, so we have 5 questions here. Hopefully walking through some of these questions will help you think about what the answers are going to be in relationship to the other questions. And like I said, it's something that I hopefully will be able to do on a continuous basis over the next couple of weeks. So everybody have a great evening, and we'll talk to you later. Okay, bye-bye.